So we've been planning on doing this for quite a while. Took us a little time to find the right person, and we finally did. He is an economics professor with Fox Valley Technical College. Professor Rick Reid is here. Good morning, Professor Reid. How are you?
Good morning. I'm doing well. And you?
Yeah, we are wonderful. Thank you so very much for joining us. As we always say on our show, we are not experts. We are expert adjacent, which is why we bring in people like you to explain things. I think, we hear all these economic terms Professor Reid kicked around, and I know in some circumstances I just kind of nod my head and go, and I have no idea what they're talking about. So if anybody has a question, some basic econ questions, here's your chance to get them answered at 855-752-4842 or leave a comment on the live stream. You can also shoot us an email at janesays@civicmedia.us. One of the first things I wanted to ask you, Professor Reid, is about treasury bonds. Now, it was either last week or the week before that there was a lot of turmoil among the bond market. Can you explain first and foremost, what is a bond? What does it do?
You bet. A bond is basically a debt instrument. So when we hear a lot about the nation's debt and deficit, right? The bonds are the way that a country like the United States borrows money from people willing to lend it, right? So when we talk about the national debt, for the most part, we're talking about how many treasury bonds, bills, and notes we have extended. And basically what the government does is it writes an IOU and sells it to someone who's got money to lend.
So I could do this as an individual. I can invest in a bond market, and essentially the government is taking out a loan from me.
Right. Absolutely. And
Wow.
countries around the world use that vehicle to generate funds.
And other countries can also buy our bonds. Is that correct?
Absolutely. And we buy theirs too.
So when this happened, either last week or the week before, I forget. Forgive me. Um, this distress over the bond market. What did that signify?
Um, well, I think there are a lot of people that are scratching their heads on that right now. One of the things that you expect with a U.S. Treasury bond, we want to step back for a second and recognize that the U.S. is a little bit different than many other countries, in that the U.S. Treasury bond has never defaulted. So when you lend the U.S. government money,
It's a
it's kind
safe
of a
bet.
sure bet, right? It's about as close as you can get to a sure bet. You're going to get your money back. It's not like somebody's going to take your money and run. So for that reason, the U.S. Treasuries historically have had an extremely low interest rate, right? Because it's very low risk, right? So when you
Sure.
think about that in contrast to other investments, um, if you have a retirement fund, a 401k, whatever, you probably have a mix of some bonds, stocks, maybe some corporate bonds, and some other instruments. But when you're buying U.S. Treasury bonds, that's really kind of your that's almost cash in terms of certainty of being able to access it and knowing that it's going to be there and hold its value, right? Um, so the other thing that does is because it's a low interest rate, it effectively, because it's so secure and so reliable, it ends up establishing a floor for interest rates for other things, car loans, mortgages, everything in our world. Um, so with that kind of a backdrop, we're taking a very low risk instrument that's very reliable. It's never had a default. And now, as a result of things that have been going on in the news, the market has basically communicated that investors are starting to pull away from the U.S. Treasury bond, right? So when you buy a bond, you get paid interest semi-annually. By the way, when we talk about a bond, there's a lot of different categories, a lot of different denominations and durations. It ranges
Sure.
anywhere from 3 months to 30 years. Okay,
It's
it's a pretty
so
big
we're
spread.
talking like a CD does, right? So you're going to
Like a
invest it
CD.
for so many months, for a certain length of time.
Right, right, right. And so you buy it and it has a stated rate of interest and you get paid that. Now, when the investors aren't quite as interested in lending money to the government for whatever reason, a variety of different reasons, what ends up happening is the selling price of the treasury bond um, moves down to be able to provide the investor with a higher rate of return, known as a yield. So what you've heard a lot about is yield rates on bonds, and that basically is the interest rate plus the difference in selling price that you would normally expect for that bond. So when the yield rates go up, okay, the yield rates go up,
Yep.
the price of buying a bond has fallen. It's cheaper. And what that tends to signify is that investors need that little extra incentive to be able to buy it. They're not as interested.
And
So what,
does that indicate less confidence that the government is going to be good for this?
well, that's a good question. Yeah, with um, uh, standard economics answer, it depends. So it could be that it could be general uncertainty in the marketplace. It may not be so much that the government's not good for it, as much as the um, variety of events that are happening all at once are happening, and in a way that creates a great deal of uncertainty, unreliability. So again, getting back to the idea of why you buy a bond, you buy the bond for certainty. You know you're going to get paid. You know what you're going to get for an interest rate.
Yep.
There's really no question that it's kind of a certain thing. When that starts to move up and down in terms of a yield rate, that's kind of a signal that the market is not quite as certain about the value of the bond anymore, and or the future direction of the economy overall. So it can be an indirect measure of consumer confidence.
If you're just joining us, we're talking economic nuts and bolts with economics instructor Rick Reid from the Fox Valley Technical College.
So, Rick, one of the things we were talking about last year was looking at the economy as far as like, all of the economic indicators. So like everything showed that we could see that the economy was doing well. The jobs were up, the markets were up, interest rates were we weren't seeing anything that was showing huge problems. But of course it didn't translate to a lot of people because they don't care about the Dow Jones. They don't care about how many jobs are added. They care about the food they're buying. They care about the gas they're putting in their car and interest rates on their homes and things of that nature. The question I have is for those who are interested in this topic, what are the indicators they can look at to give them a better idea of how the country is going economically forward? Like, what are the things that they need to look at to just get a basic idea and understanding so they can say, oh, yes, egg prices, I'm just going to use egg prices because we weaponized eggs in this country. Egg prices have gone up, but I also know that the Dow Jones is at like 45,000 this week. So I know that businesses are doing that. What are the economic indicators they can look at to see where we are as a collective country, as a macro look?
Yeah, there's a couple different ones, and you make a really good point. Last year we had a situation where people weren't feeling that the economy was as good as it really was. We had a really low inflation rate; it had been coming down. We had full employment. We have full employment still, um, but oftentimes there's a what economists call a time lag, so that when things change, it takes a while for it to be felt by you and me and everybody
Right.
else, right?
Right.
So when prices are coming down, we that's great, but um, we remember them being higher. And oh, by the way, when they were higher, our wages didn't go up quite as fast. Wages always lag behind prices, right? So the price goes up, our wage is going to be later to arrive at the show. Um, so I guess one thing that I would look at is the CPI. That's just a real easy figure to look at. Um, Consumer Price Index. What do you expect for inflation? The Federal Reserve has targeted uh, two 2% to 2.5%.
Mhm.
And so if that's close to 2.5%, that's good. Unemployment. If the unemployment rate somewhere between 4 and 5%, that's normal. That's what we would expect. That 4 to 5%, generally speaking, are people that are leaving a job voluntarily to find a different job or because they've got a different job lined up. Um, so that's another good indicator. And frankly, I think an easy indicator to look at is to look at the Dow Jones average and just see
Okay.
what that's doing in the S&P and see where they're trending.
I do feel like there's a disconnect though between folks.
Mhm.
When you look at the Dow, it's like, well, great. Again, very wealthy people and people who can afford to, be day traders and all that. They're doing great. But what does that mean for me if I'm just a regular Joe?
Right, right. Absolutely. Absolutely. One of you mentioned the debt. And one of the things that comes up with the debt is that if the yield rates are rising, what that means is that the government is having to pay a higher interest rate now on the debt that it accumulates, right? So think about your own household. If you get the statement from whatever department store that you work with, and the credit card rate is going up by 2 or 3%, you panic and you kind of go, "Oh my gosh, I owe $1,000 on that thing. Now I'm going to owe that much more in the monthly payment." It's that multiplied by several fold when your debt is $37 trillion.
Yeah.
That's a
And the
lot.
interest rates are rising. So
I am
all of
not
a
an
sudden,
economics professor.
it's a
That's a lot.
similar reaction, only much bigger.
Yeah. um, well, we have to go to break, but I do have a question. I want to go back to with a question when we come back about inflation and the number itself, because that one is a sticky point. It's used once again as a weaponization of the economy to get people happy or very mad.
We're to continue our conversation with economics. Professor Rick Reid is here. If you have a question, 855-752-4842. You can leave it on the live stream as well. We'll be right back. You're listening to Matt Nair on Air. This is the Civic Media Radio Network. Good morning. Welcome back to Matt Nair on Air. Jane Matt Nair, Greg Bach, and Caliente on the board. Coming to you from our studio here at Radio Park in Racine. You can join us, call or text at 855-752-4842. Leave a comment on the live stream on Facebook, YouTube, and what used to be Twitter. We are talking economic nuts and bolts. And we've been trying to do this for a long time.
Yeah.
Really delighted to have with us economics instructor Rick Reid from the Fox Valley Technical College. And Greg, you had kind of a follow-up to a question we had right before the break.
Yeah, before the break, you were talking about the economic indicators, and one of the things you brought up was what to see inflation as far as the percentage number. And you said about 2 and 2.5%. But we see politicians on both sides, all politicians, wanting to talk about getting rid of inflation, knocking it out, being done with it. But there is a cost that comes with 0% inflation, correct?
Oh, absolutely.
Can you speak on that?
Oh, sure. Okay, so let's go back and talk a little bit about what we mean by inflation. And when we define inflation, what we're really talking about is the overall level of prices and wages are rising. Okay, that doesn't mean one particular price or one particular wage. We're talking about the market basket of wages and prices over time. Generally speaking, economists agree that there needs to be some modest upward movement in terms of the prices and wages over time. It doesn't need to be very big, but just a little bit, right, to allow for growth and expansion, et cetera. When you get to zero, the risk you run is that you start to fall negative. Zero is not necessarily in and of itself bad, but it's a really specific number, and it's really hard to fall off. And think about sitting on the edge of a fence. You don't want to fall on the wrong side of the fence. If you go below zero, if you start to see falling prices, you necessarily will see falling wages, right? Because your employer all of a sudden is taking in fewer dollars.
Sure.
Each dollar is worth more. And therefore, when you get your paycheck, it's likely to be trending downward. And the employer shrugs their shoulder and says, "Yeah, but the dollars are worth more. It buys more. So you're okay. You don't feel okay, but you know."
Right.
So when we talk about falling into a recession or depression, that's one of the characteristics that you're running into is the overall decline in prices and wages. So
We have a question from someone on the text line. John from West Bend said, please ask Professor Reid about the claim that the government has borrowed from Social Security and never paid it back. It's my understanding that Social Security buys U.S. bonds and then uses the proceeds to fund Social Security per U.S. law.
Right. So that's an interesting question. The thing is that if you buy a treasury bond, you could very well roll it over, sell it at the end of the maturity date and buy a new bond. Okay. So from that perspective, if that's what Social Security is doing, then Social Security, in effect, is continuing to borrow money or lend money to the federal government. And that's certainly a possibility. And just like any other investor in a treasury bond, the interest rate or yield that comes off of that investment is revenue, income, and it can be spent any way it wants. So, but I think one of the things that is maybe a little bit implied in the way that was worded is that the U.S. government is declining to make Social Security whole. Social Security is, in this case, borrowing money. It does so like any other investor, borrows it at its will.
Thank you. We have one more question, and we've got about 2.5 minutes left, Professor Reid. Are rich people the only ones who buy bonds?
Well, if you think it trends towards that because it's, let's face it, bonds are pretty expensive. I think you can buy $100 bond. You certainly can buy $1,000 bond, and then it goes up from there, pretty significant numbers. Institutions are more likely to buy bonds. And by institution, I mean the company you work for, the investment house. If you're lucky enough to have a 401k or an IRA, there's a good chance that one or more of the funds that you're investing in includes some treasury purchases. So it's something that you don't necessarily even give a lot of thought to necessarily. Yeah. I'm sure it's in the fine print somewhere in the disclosure agreement, but so those are typical investors. And yes, it could be wealthy people as well.
855-752-4842. If you have a question for Professor Rick Reid, we're talking economic nuts and bolts. David from San Francisco has been patient. We don't have a whole lot of time, David, if you can make it quick, please.
Oh, well, yeah, I was just going to give, I posted this on your Facebook, the show. Bonds are fixing our stuff. We've got library bonds, sewer bond issues, whatnot. And Trump is known as a slumlord. And a slumlord is not reliable for maintaining maintenance on property. So what I just posted on the Facebook page, he wants to cut off sewer repairs in Alabama because he calls them DEI.
I appreciate it, David. Again, we don't have a whole lot of time, and we're trying to keep this non-political,
more educational,
and again, the economic nuts and bolts, so we can all understand what's going on. We are out of time. We got a minute left. Professor Rick Reid, economics instructor at the Fox Valley Technical College. We would love to have you back. There's so much more to talk about. Really appreciate your time, Professor. Thank you so very much.
You're very welcome. Thank you for having me on.
News is coming up next. Stay with us. You're listening to Matt Nair on Air. This is the Civic Media Radio Network. We'll be right back.